One.
Hey everybody, Tom Deutsch here, Director George and Janet Matthews with Symmetry Financial Group. Want to welcome everybody to the DFL Debt-Free Life Call hosted by Senior Analyst Scott Forehand. I'm going to introduce him in a second. Just to give you a little background information, the Debt-Free Life plan was put in place by Symmetry about a year and a half ago, and in the first year, we've helped families retire over $55 million in debt, saving them about over $243 million in interest, and most importantly, increasing their retirement by about $2.1 billion. Scott Forehand started right out of the gates as soon as we got the program going. And I know my numbers are a little bit old, Scott. You're going to have to update me, but I know it's more than 60 families. I know it's more than 35 million in debt eliminated, and I know it's more than $100 million in additional retirement living funds. So without any further ado, I just want to introduce Scott and thank you very much for being here.
Well, thank you very much, Tom. And I haven't updated those numbers in a while, but I know we placed 8 of them this week. So yeah, we're still rolling. Anyway, Scott Forehand, welcome to the Debt-Free Life, the bi-monthly Debt-Free Life presentation. A lot of you are familiar faces. It's nice to see you, at least remotely. And some of you are new people, and some people I can't see any face. I just see a name, and that's fine too. But anyway, welcome. Hopefully you get something out of this. This presentation, the purpose of this is broken into 3 parts. The first part is going to be kind of a 30,000-foot view of what debt-free life is, what it can do, how you can use it. The next segment will be one topic, an advanced topic, either a funding topic or a usage topic, or even how you would interlace this with another advanced market scenario like annuity stacking and things like that. And the third segment will be just a kind of a Q&A session. We are up against a hard break at 6:45 tonight because we'll be heading into the advanced market annuity training after this with Jamie McCrae. But we'll stay on as long as we can if we have questions. And without that, let's get going. So let me go ahead and get this up. And here we go. So again, we're here. This is for Debt-Free Life. My name is Scott Forehand, and I'm with Symmetry Financial Group. Debt-Free Life is a proprietary product that was brought to market in the May-June of 2019 timeframe by Symmetry Financial Group. The concept of Debt-Free Life and the precursors to Debt-Free Life it's not new. It's something that's been done for a long time. It's just either it wasn't available to us because we didn't have enough money to play the game, because it was typically a rich person's game. You had to have about $10 million to start one of these programs previously, or it was a situation where the vehicle that they were going to use, whether it was a home equity line of credit or a lower interest rate credit of some kind or something along those lines, had a propensity to fail at some point during the program. And there's some people out there, some big names you'll recognize. I'm not going to advertise for them because what they say is not completely correct, and their programs will typically fail. But this is, like I said, not a new concept. It's really it's a combination of 2 events, 2 different financial tools, if you will. One's called infinite banking, and that's just a concept where you get to use your bank over and over and over again, like a bank currently uses your money. And the other thing that we use is called debt snowballing, which is true debt snowballing, not debt stacking, which most people think is debt snowballing. So anyway, let me welcome you. If you're here, it's because you're either a Symmetry agent trying to learn a little bit more about this program, or you're a client of one of our Symmetry underwriters or brokers. And either case, welcome. Hopefully you get something out of this. The whole idea behind Debt-Free Life is it's a battle plan to defeat debt. And most Americans have it. We're taught from a very early age it's okay to take on debt. And as we grow up in life, and we make more money, we become more and more reliant on debt as a capital source, unfortunately. And then in the end, we end up, and the creditors love us for this because we become essentially indentured servants to them until we're able to pay off that debt. And by the time we're ready to start looking forward to a retirement solution, we've just finished paying off our debt, and now our retirement's not where it should be. So most of the time, as a Symmetry person, these are the two standard questions we're going to ask. First is, are you 100% sure that you're going to have a great retirement? And I don't know anybody that can say yes to that, save for a few overly competent, uh, um, overly pompous individuals who think that they know everything, and then they're usually wrong. But I don't know anybody that can honestly say they're 100% certain they're going to have a good retirement or a safe retirement. The next question is, if we could show you a way to get out of debt in 9 years or less, paying off everything, including your mortgage, without you spending any more money than you are today, would you be interested in listening to us? And if that was one of the questions that got you here, fantastic, because we're going to show you something a little bit different that's even better than what that question kind of puts into your mind. So if you're like me, and you're like most of the people on this call, the average American, this is how your dollar is spent. About 3% of your dollar is saved for retirement. About 34% of your dollar is paid out in interest. About 40% of your dollar is paid out in taxes. And that remaining sliver, that 23%, that's what you use to live on. That's what you use to pay your power bill, your light bill, put food on the table, and maybe if there's enough left over, pay your Netflix bill. That is absolutely not the way that the founding fathers of this country envisioned this country to be. It's not the way it's supposed to be, and it certainly doesn't have to be that way. But the people, the money lenders in this country, the banks, they certainly want you to continue to think the way that you're thinking right now, because that's what makes banks profitable. So moving on, if this describes you, then welcome. You are the average American, just like the rest of us on this call. Like most of us, over the course of your lifetime, you're going to make a fair amount of money. The average American is going to earn about $2 million in their lifetime. And that is a lot of money. And the reality is, if you control your spending, that's enough money to do everything with. That's enough money to live, have a life, have retirement. The problem is that when we're starting down this road, like I said just a minute ago, we're all taught that it's okay to take on debt, and it's not. And it doesn't have to be that way, but we do it anyway. And when we turn 18, we buy a car. And then we go to college and we get student loans. And then we find a wife or a husband and we get married and we buy a house. And then we have kids and then we're helping them with their debts. And eventually we get to the point where all that stuff's taken care of. And now we're left over with what you see down there. The average American has about $60,000 at retirement available for retirement. That's the average American. Some people might think that they're doing great because they got 150. Some people who really got it figured out, they've got over 7 figures, which is great. But most Americans are at that $60,000 mark. And if you think about how much money you make right now, and think about that retirement day when you're going to take a 40 to 60% drop in your income level, that $60,000 is not going to last long. So what we're doing here, and these programs work, folks, for people of all ages. If you're under 75 years old, we can get you into a program that will work. And I've done one for 73-year-old, 74-year-old, and a 75-year-old in the last 2 months, and they do work. So don't think it's too late. Okay, it's not. If you're 50 years old, you are certainly beyond the point where you should be in a risky environment like a 401k or TSP or a 403, because that's just not safe. If the market goes up, the market comes down, guess what? You're going down with it. So it doesn't have to be that way. This program is insulated from all that. So moving on, $60,000 is probably where you're at. It doesn't need to be that way. It can certainly be much better, and we're going to show you how to get there. Next, of your traditional approach, if you end up having a lot of debt and you go to someone who's a debt consolidator or a debt negotiator, they're going to give you that bullet list on the right side of your screen talking about different ways for you to get out of debt and change that retirement savings sliver from 3% to something larger. And they're going to tell you to go get a second job, refinance your debt, consolidate, spend less money, work harder, eat tuna fish and ramen, right? And then the one thing down there that actually does work consistently is going to be that debt snowball. And that's something we're going to talk about a little bit later on. But that is the only thing of those things that you show you here that is not going to be, that is not going to fail at some point. If you work harder, you get sick, what happens? Well, you lose both jobs. Spend less money, that's great. What happens to your lifestyle? It goes down. How long can you keep up with that? Most people can't. Save more money, that's a great idea, but if you're not making more money, how can you save more money, right? These are all those things and all those reasons why those concepts there fail. Refinancing, turn one debt into another debt. That's not the, it doesn't work. Okay. So that's kind of like the federal government's approach. It doesn't work. You can't spend your way out of debt. Consolidate your debt. There's no difference between consolidation and refinancing. You're just turning all your debt into one debt. It's doesn't work consistently. So now we're back to that one question. If we can show you a way to get out of debt in 9 years or less, would you want to hear about it? And that's the critical concept here, folks. We are not trying to create a bill for you. We're not trying to create an additional debt for you. All we're trying to do is show you a clear path of a way that you can spend money differently. Okay. Same money, not asking you to go out and get another job, not asking you to spend any more money than you're already spending right now. We're just going to change the way you spend money and make you spend that money more efficiently. How's that happen? Well, we want you to get from the left side of your screen where you're the average household with 3% of your savings for retirement over to the right side of your screen. So if you remember that slide I mentioned earlier, where we talked about the average American making $2 million and having only $60,000 available at savings at the time of retirement, if we take that and just run that number from 3% to 15%, what that means is we're going to create $300,000 of retirement savings. Okay, so if you look at a standard 5%, that's about average that you can get on a good rate with someone to give you return on your money. If you're looking at a standard 5% return on $60,000 as an investment, that means you're going to get about $3,000 a year. That's what it's going to earn for you. That's not enough money. Okay, but contrary to that, $15,000 with a $300,000 investment is a much better. It's still only $15,000. Can you live on it? Maybe. Depends. But the point is that that's just taking the interest. So if we can get you to the point where you've got $300,000 in retirement without you spending any more money than you're already spending right now, then you're a heck of a lot better off. How do we do that? Well, both of these are just pie charts, and they're both 100% of the money, $1. Okay. So if we save 3 cents for retirement on the left side, if we can get you to 15 cents for retirement on the right side, where does that money come from? It comes because we're decreasing the amount of money you're spending over time for things like taxes and interest. And those are the two biggest killers. If you look on that left side of your screen, taxes and interest occupy almost 75% of your income. And that's way out of control. Okay. So how do we fix that? Well, we use vehicles and programs and financial instruments that are tax exempt. That's one of them. We pay down debts with interest quickly. So we eliminate that long-term interest that you're paying. That's another. And simply by doing that in a most cost-effective and cost-efficient manner, we're going to get you to that point where that lifestyle, that 23% that you have right now to pay your power bill, your gas bill, your food, and buy your water bottles and do whatever you're doing with your money, and maybe have money for that Netflix bill. We're going to increase that by you can see 23% to 33%. That's actually a 43% increase in disposable income. So if you think about this right now, if you know your current financial situation, and you know that you have, let's say, $1,000 a month left over at the end of every month, which is a lot. Most people don't have that, but that's a lot. Okay. If I can change that from $1,000 a month to $1,430 a month, that extra $400, that's a big deal. That's the difference between taking a staycation and taking a vacation. That's the difference between buying some inexpensive off-name brand bottle of wine and buying something that's got a name that everybody recognizes, Moet, things like that. Okay. So, and I'm not saying you need to go blow your money on stuff like that. That's not what we're talking about. But what the nice thing would be is, what if you had the option? What if you had the ability to make that choice to do it? That's what we're trying to do for you. We're going to show you how to make those choices. In the interim, we're going to increase the amount that you save for retirement by 500%. Yes, you heard me, 500%. We're going to decrease what you're paying in taxes over time by 25%. We're going to decrease the amount of interest you pay over time by 35%. And as I've already mentioned, we're going to increase your money for lifestyle, your disposable income by 43%. That's huge. That's another thing we also know with these programs. If you have to come out of pocket and it puts an extra burden on you financially, it's not going to work. It's got to be something that's relatively painless. So we know that all we're going to do is use money that you're spending inefficiently. So in theory, most of the time, these programs are going to be zero cost to you. That means you're not coming out of pocket anything. We're just going to find places where you're spending the money wrong. Okay. So how do we do that? It's what we just talked about. We're going to eliminate your debt quickly, reduce the taxes, reduce the interest, improve your cash flow, your lifestyle money, and allow you to retire. This says tax favored. The truth of the matter is this program, if you structure it correctly, is the most tax favored way to have a retirement income stream, which is tax exempt. The IRS can't touch you. The IRS can't tax you. They can't penalize you if you take your money out too soon. They can't penalize you if you take your money out too late. They can't tax you if you take it out too soon. You don't have to leave it into a certain age. You don't have to wait till a certain age to touch it. You don't have to, you're not forced to take it out at age 72 if you haven't started taking, like all those problems with 401ks and 403s and all those other retirement income vehicles that are out there that people know about that are not all they're cracked up to be now. So let's get a little bit more into it. So when we were structuring this program and doing an analysis on the programs that have come before us, we looked at the main reasons why they all fail. And every one of them has an Achilles heel. And we identified what the Achilles heels were for those different vehicles. And we put stopgaps in place for those programs to make sure that they wouldn't be, that this program won't fail. As long as you follow it, it won't fail. And one of the biggest things that we saw was that those programs didn't plan for an emergency. It's a nice thought to be able to pay into a program for 20 years, but what happens if something happens to you and you can't work anymore after 5 years? Well, there's an emergency fund in here. What happens if you've in one of those other programs, let's say you've just drained it because you paid off some major debt, but then you drop a transmission, you need to put a new transmission in your car. The one thing that we do know is that life will happen. And the program that we put together and the game plan we put together is just a game plan. That's all it is. We know that things are going to happen. Life is going to change and life's going to happen. And we're going to have to make amends and be able to pivot when we need to. Our system allows you to do that. Of the money that goes into the program, you're only going to see about 80% of it. And we have there's a 20% emergency fund that's hidden. And I'll talk about that a little bit later about where it's hidden, but it's not going to be something that you're going to see, nor is it going to be something that you're going to be able to get to easily. It is still there. It is still your money. You can still get to it when you need to, but it's not going to be easy. And we don't want you to take that money out and go buy a jet ski with it. We want you to use it for a real emergency, only if you have a real emergency. Okay, moving on. So when we analyze these programs, the thought was, well, what happens if you put $10,000 into this program that is a tax exempt program versus putting $10,000 into a tax deferred program like a 401k, a traditional 401, or putting $10,000 into a Roth program? And these are the numbers that we come up with. And the idea is that there is no way you can compare a $10,000 investment on those three vehicles and look at the return. If all of them get an average of a 7% return, if all of them are, when you pull the money out, you're at a 25% tax bracket, which let's stop there for a second. Does anybody think that we're going to be at a 25% tax bracket when we're able to pull money out? We know that Social Security is going to be bankrupt in 2030. We know the federal government spends money like it's going out of style. And we know that ultimately that money is going to have to get paid back. So the federal government's going to have no choice but to raise or increase taxes. So when they do that, that illusion or that nice utopian thought of having an only 25% tax bracket, that's going to go out the window. Realistically, the numbers that I've seen and some of the projections I've seen, we're looking at somewhere between a 30 and a 35% tax bracket for adults, anybody over 18, probably within the next 10 years. So even that number's light, which makes this illustration that we're doing work even better, because our system, the DFL system, is tax exempt. So that's why no matter what, if you use the same numbers, whether it's a 25% tax rate, 35% tax rate, 50% tax rate, it doesn't matter. Across the board, if you're earning an average of a 7% interest and you let the money run for 10 years with a DFL program, you're going to be at 66,000. With an IRA, you're going to be at 49. With a Roth, you're going to be at 41. That's the numbers, using the same numbers across the board. So no matter what you do, no matter what you look at, this program is going to have a better return, and it's going to be tax exempt. And where we look at comparing it to a traditional IRA and a Roth, I don't have to wait till I'm a certain age to take the money out. I don't have to get penalized if I take it out too soon. And if I get to age 72 and I don't need the money, I'm not forced to take the money out like I would be in an IRA. Moving on. If you haven't figured it out, I'm not a fan of IRAs. Okay. So how does debt-free life work? So debt-free life works in three parts. We have the maximization phase, the accumulation phase, and the distribution phase. Remember how I said earlier that this uses two financial instruments? One's called infinite banking and the other's called debt snowballing. Well, in the maximization phase, we're going to maximize the growth of your money, get you to the highest growth rate possible as quickly as we can by using those two programs, by using the concept of infinite banking coupled with debt snowballing. So as we pay off a debt, the minimum payments on that debt are going to get rolled up into your monthly payments into the program. So what that means is that every time you pay off a debt, you're actually saving more and more money every time. And that money's compounded. That's why we use the three companies that we use to do this program. All three of them are going to pay a compound interest for this, guaranteed at 4%. So the maximization phase gets you to the point where you've got all of your debts eliminated, including your mortgage. It usually lasts anywhere from, I've seen it as quick as 3 years. I've seen it as long as 15, but typically it's going to be somewhere between 7 and 27 years faster than what you're already on track to do. Once we get you out of debt, then we move into the accumulation phase. So for those of you that are looking at this vehicle as purely a retirement vehicle, where you don't have any debt and you don't have any mortgage, that's where you actually start the program. So this program works for everybody, whether you've got debt or not, whether you're looking for retirement or not. If you're looking to eliminate debt, you're going to start in the maximization phase. If you're looking to increase your retirement or have a better retirement, you're going to start in the accumulation phase. And then at the end, if you haven't started a program, you're not going to start in the distribution phase, because that means you're already ready to retire. But the distribution phase is where you would be able to go ahead and spend the money at your will. Do with it what you want. It's your money. All right. So when we're in the accumulation phase, we're going to accumulate all those extra premiums that you were paying for your debt. We're going to continue to pay those premiums. We're going to continue to pay those debts. But instead of paying the carrier or the lender or your creditor, you're going to be paying yourself. And that's where this thing really, really flies and really, really blossoms. This is where the one downfall for this program that I found exists. You've probably all heard those stories about people that win the lottery, and then within a couple of years, they're back to being broke. This is the same kind of situation for folks. If they're not adept, or they haven't been experienced at handling large sums of money, that accumulation phase is where you're going to see that. And I don't mean $5,000, $10,000. I mean hundreds of thousands of dollars in these programs are going to accumulate. And you have to be wary and make sure you spend the money, if you need to spend it, on an appropriate expense. Okay. And I'm not going to preach. And I told you before, this is not a new program. I told you before, this has been done for a while, and these are some of the people that have done it and continue to do it. Disney did it when he started Walt Disney World. He used what this is called, which is a participating whole life product. He used participating whole life to help fund his vehicle, but he had $10 million to start. Doris Christopher used it for Pampered Chef when she started that. Ray Kroc did it with the first 3 or 4 McDonald's that he opened, and Warren Buffett still does it with Berkshire Hathaway. This is part of the Buffett method. So this is not new. It's still in practice. It's been something that's been around for a long time. The richest people in the country have been using this program to transfer wealth generationally from family to family, from family generation to family generation, avoiding tax, avoiding IRS intrusion, avoiding, even more importantly, lawsuits, because it's tort proof. So this is not anything new. What we have is the newest version where we've looked at, like I said before, we've looked at where were the Achilles heels for the other programs that came before us, and we've put stop gaps in place to protect against those. So we're going to harness the power of a life insurance policy. I said it just a second ago. It's a participating whole life policy. What does that mean? That means that just because you take out this life insurance policy, you're able to participate with the profits of the carrier that issues that policy on you. Does anybody have any doubt that the most financially sound and richest companies on the planet are life insurance companies? Okay, if you didn't know that, welcome to my world. Life insurance is the safest kind of investment on the planet. That's why banks use it as an investment vehicle. And that's why we're using it as an investment vehicle. So what do we do? How do we do it? The bullets are right there. We're going to redirect inefficiently spent dollars. That's what we talked about earlier. We're going to help you spend money more efficiently. We're going to get the cash value to grow at a guaranteed rate. And it's a guaranteed minimum rate. There is no maximum guarantee. It can go up and up and up, but there is a minimum. And the floor for all these programs is 4%. We're going to borrow money on the cash value of the policy. So when we pull money out of these programs, unless we're using that emergency fund, we're never actually going to be taking our money out, which means our money is going to stay in here and work for us in perpetuity, forever, until you pass. And if you do it correctly, you can even make that go on generation to generation to generation. So you can, at some point in the future, transfer some, most, or all of the cash value of one of these programs to your great grandchild. And thereby, that's making your wealth run 3 or 4 generations. Okay. Pay off your debt in 9 years or less. Talked about that earlier. It's really 7 to 27 years early. Policy loans. Yeah, you heard me say that a minute ago. You are going to take a loan when you're pulling money out of this, but the loan may not, you may not need to pay the loan back. And there's a program that we can incorporate where the loans will automatically get paid off simply by the growth of the vehicle. So people ask that question, what do you mean I don't have to pay my loan back? How can I do that? Well, it's because we know what we're doing, and that's how this program can be structured. It's called positive arbitrage, and we'll talk about that in just a minute. One other thing I just want to bring to light: this program is not set in stone. It is flexible, and like I said earlier, we know life is going to happen. So if something happens and you need money, by all means, use it. Just make sure that you're using it for an appropriate reason. And I don't mean going out and buying that new jet ski. I mean, you dropped a transmission. Your house is in Tornado Alley, and it's going to take 4 months for State Farm to get out to you so you can get a new roof, and you need a new roof now. Whatever the reason may be, if you need the money, use it. But remember this is a bank. We're creating a private bank for you. So you are the banker. You make the decision of whether or not you are going to lend yourself the money. Okay. There's a flip side to that sword. There's a double-edged sword here. That means you also decide what interest rate you're going to charge yourself. Should you charge yourself 0? Maybe. I would charge myself something, make my money work for myself, and pay myself to lend money to myself. Does that sound crazy? It kind of is, but it's awesome and it works. I'm doing it. It works like a charm. Okay. So don't forget, and this is the last thing, this program is built on a life insurance policy. Life insurance, right? Which means beyond the creation of this private bank, you also have a massive death benefit that's going to transfer wealth from family member to family member, from family member to beneficiary, without probate, without taxes, without loss of that amount of money. It's fantastic. And when I say massive, I mean realistically, most of these programs I see get up to $1 million or more. All right. moving on. So this is an old slide. This is when we first started in the first month, and these were some of the families that we helped. That is, after I've done as many of these as I have, those numbers are way, way light. This is not what we're looking for here. Realistically, I see the average person, we're retiring somewhere around $250,000 to $350,000 in debt. That's just pure debt. If you look at the amount of debt we're actually retiring with interest, it's usually $500,000 or more. And we'll talk about that in just a minute. So let's explain to you how things are different between two programs. So this is how you currently spend money. So you go out and you work your job, whether it's a 1099 or a W-2, W-4, maybe you own your own business, sole proprietorship, doesn't really matter. You make your money. Your money gets deposited into your bank. Whether you bank with Wells Fargo, Navy Federal, Citibank, Bank of America, doesn't really matter. But you bank with the bank. You put your money in the bank. As soon as you put your money in that bank starts lending it out every night. Your money's in their bank, they're lending it out every night. They're making money with your bank, with your money over and over and over again. The average dollar that you put into your bank gets lent out 7 times before you actually use it. So there are some very generous banks out there that will give you 0.25% interest on the money you have in their bank. Most banks will simply say, yeah, you've got over $2,500 in your account. We're not going to charge you for you to keep your money in our bank. And that's most of the time their position. And I don't like it. And I'm tired of it personally. In the end, they've used your money 7 times. You haven't made anything with your money. They've made a lot of money with your money. And then you tell them, either because you wrote a check or because you went into your bill pay system and asked them to go ahead and pay your debt, you say, go ahead and pay my debt. And then what happens? Your money just became your creditor's money, and your money's gone forever. So that money is gone forever. And if you're really, really nice and really, really sweet, will they give you your money back? No. Your money's gone. The bank, you put it in the bank used it, you told the bank to pay your debt, the bank paid your debt, now your money's gone, bank made money with your money, and that's it. The only thing you have left to show in this scenario, which is the way that 90% of Americans do it, by the way, the only thing you have left in this scenario is the fact that your debt is now paid. That's it. What if there's a better way? So let's talk about the better way. This is the debt-free life way. So you make the same money. You work whatever job you do. The money gets deposited as income into your bank account. Whoever you bank with, it doesn't matter. Here's where the program differs. Our bank, we're gonna pivot here. So we're gonna take some money out of our checking account and we're gonna pay our life insurance premium, which means we're gonna pay for our participating whole life policy. Yay! What does that mean? It means I wrote a check. I wrote a check to my life insurance carrier for my life insurance policy. Okay. Remember, I said this was a participating whole life policy. So that policy has 2 other riders on it also. The first one is called a term life rider. So most people know what whole life is. Whole life is a life insurance policy that is permanent. Once you take it out, it will be there until you die, unless it runs out of cash or you stop paying your premium. And that means it's a permanent life insurance policy. Why do we need a term life? For this program to work, the program builds a very large cash value over time. And IRS tax code 7702 says life insurance policy, any money derived from a life insurance policy is tax exempt as long as the life insurance value exceeds the cash value. So in this case, if I had a whole life policy that was growing at the rate that this program grows at, the amount of cash in my program would exceed the amount of my whole life policy fairly quickly. And then the IRS would recognize this program not as a life insurance policy, and we would lose our tax exemption protections that we have. And it would then start to recognize this program as what we call a modified endowment contract, a MEC. And if the program becomes a MEC, the game's over. Everything that's in there becomes taxable. So we want to avoid MEC at all costs, because that's one of the benefits of this program, is that I can put money in and take money out in a tax exempt fashion whenever I want. So That's why the term life is there, because it creates this umbrella, this big umbrella over that whole life policy, so I can have the cash and the whole life grow while this life insurance umbrella is up here over it. And I'll be able to say, okay, I'm growing, I'm growing, I'm growing. Great. Can't touch me, IRS. One last thing, and this is the magic. This is the magic of this program. There's a third part. When we make our single premium payment, it gets split into three parts: whole life, term life, and paid up additions. Here's how the percentages break down. Typically, the paid up additions is going to occupy most of our program money. About 68% is going to go into the paid up additions. I'll explain to you in a second what that means. About 11% goes into term life, and somewhere between 10 and 11% goes to fund that whole life policy, and the remaining 10 or 11% becomes cash value in that whole life policy. That's how the 100% breaks down. So if I spend $100, I'm going to get $10 cash value in the whole life. I'm going to pay $11 for the whole life policy. I'm going to pay $11 for the term life policy, and the remaining $68 are going to be buying paid up additions. So a few minutes ago, I alluded to the fact that life insurance policies are very safe investments. Banks recognize that. As a matter of fact, Wells Fargo has 48% of their tier one investments. Tier one means the safest kind of investment. 48% of their tier one investments are life insurance policies that they've bought. So what does that mean? There's these companies out there called viatical settlement companies. And what they are is they're companies that go around, and if you've got a life insurance policy that's got a value and your life expectancy is 10 years and it's going to live, that policy is going to exceed your 10-year lifespan, they're going to give you money for you to make them the beneficiary in the policy. It's a viatical settlement company. It's an investment. They're not going to give, if you've got $100,000, they're not going to give you 100,000. They might give you 10,000, but that's how they make money. So Wells Fargo is one of the largest viatical settlement company investors through a couple of their subsidiaries, and that's why they do it, because that life insurance, especially if it's a paid up addition, right? Paid up addition, you see that third leg. Paid up addition is additional life insurance. It's paid up additional life insurance. And once you pay for it, it's permanent. It will never decrease in value. It doesn't cost you any money to maintain it. Once you've paid for it, it's a permanent investment. So if you buy $1,000 of paid up additions today, it's worth $1,000 tomorrow. It's worth $1,000 a year from now. It's worth $1,000 20 years from now, assuming you haven't passed. And when you pass, what is it? It's life insurance. So when you pass, it pays out. Okay. So normally that would be a one-to-one investment, meaning it's not a good investment, because if you buy something for $1,000, 10 years, if it's only worth $1,000, that's not a good investment. Okay. But what happens if it gets exposed to compounded interest, which it does? That's where this becomes a massive investment, because not only is the money that you bought earning 4% compounded monthly, but next year it starts over and earns again, plus the compound. And then the year after that, same thing, plus the compound, plus the compound. So you're getting, in 10 years, you're going to be getting compounded, 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 compounded interest on top of your base. In addition, remember I told you that about 10 or 11% of that was cash stuck in your whole life policy? That's also getting the 4% interest. So what did we just do? We took $1,000 out of our checking account using that nice round number because it's easy to work with. We spent $21 or $210 on whole life insurance, of which about half is cash. We spent $110 on term life to create that massive umbrella. And then we spent $680 on paid up additions. What did we do? We moved our money into a spot where we can earn money with our money. We're doing what the banks are doing. We're taking that money, we're earning interest over and over and over again, compounded monthly on every dollar we put up into the program. We have created our own DFL bank. We've moved our money from our checking account where we're earning zero and they're making money with it into our private bank where we're making 4% plus a dividend. Aha, the dividend. Almost forgot about that one. Remember I told you can take loans and maybe you don't have to pay it back? That's because the dividends that these programs pay are structured in a manner that over time, those dividends will pay back that loan for you. All right. So, all right, Scott. So now we've moved our money up out of our checking account into our private bank. I still have that debt. I still have to make that car payment. I still need to pay off that credit card. What do I do? Well, do I take my money out? No. I take a loan. I take a loan against my paid up additions bank. All right. So think of it like this. If you go to a bank and you buy a $10,000 CD, they're going to give you about 2% interest on that. Great. And then let's say the very next day something happens and you have to buy a new car. Are they going to lend you money? Yes. Are they going to use that CD as collateral? Yes. Are they going to give it to you at what they're paying you on that interest on that CD? No. They're going to get what's called negative. They're going to get positive arbitrage for them. They're going to have your money, pay you 2% on it, and then lend you money at 6%, and they're going to be profiting the 4% difference. So for them, that's called positive arbitrage. For us, that's called negative arbitrage, meaning that we have money, we're borrowing against it, and we're, in this case, we're paying more money for the borrowed money. If a CD is the case, CD is the example. But if we do it with the DFL way, we have what's called positive arbitrage. How so? We're getting a 4% guaranteed interest compounded monthly, which means the interest is actually more than 4%. It's 4% per year, but it's compounded monthly. So you can actually make more on it than just 4%, depending on how you fund your vehicle. That's the first thing. The second thing is we get paid that dividend every year. So all the carriers that we use, of which we have 3, every year they've been in business, they've paid a dividend. They've never not paid a dividend. That, and one of the companies, the one that I like to use the most, one of the companies, they've been around for over 110 years, which means they've been through World War I, World War II, all the other wars, all the other policing actions, all the good presidents, all the bad presidents, both pandemics at this point, and they're still paying dividends. Are they a solid company? You betcha. Can you name any? Here you go. Here's a good exercise. Can you name any life insurance companies that have gone out of business? I can't. Can you name any banks that have gone out of business? I can name about 20 or 30. Can you name any investment brokerages that have gone out of business? Bear Stearns, Lehman Brothers. Of course you can. Okay. So if you want to think of the security of an investment, is your money secure in the stock market? Hell no. Is your money secure in this? Way more secure than it is in a stock market. Okay. And if we've got a guaranteed interest, just an interest of full disclosure, the potential gain in the stock market is greater than the potential gain here. Okay. Goes up. The potential loss in the stock market is equally as bad, and the potential loss here is zero. You will never lose money. And if you know how to, if you've ever been a trader or ever done investing, you understand that you really don't have a gain or a loss until you actually take the money. Okay. In this scenario, you have a gain, and the gain is locked in every year without you having to lift a finger. Every time they credit that interest, every time they credit that dividend, it's locked in permanently. Okay. So when you're talking about in terms of investment strategy, this is a no-brainer. It's a no-brainer for everybody of every age. If you're over 50, you're probably not to the point where your risk tolerance should put you into a 401 or invested in the market of any kind. If you're at 20, yes, you have lots more risk tolerance, but are you going to sit there and eyeball this? I was in an event. I used to do day trading. I lost $50,000 in 2 minutes. Okay. Because I wasn't paying attention. So in this, you will never lose money. All right, let me continue. Get off my soapbox. All right, checking account. So instead of you pulling your money out of the program, you're borrowing money, and you're borrowing money with positive arbitrage. 17 out of 20 years, even if you borrow $5,000, you're going to earn more interest with the combination of the dividend plus the guaranteed interest rate. You're going to earn more than they're going to charge you. So 17 out of 20 years, you're going to be to the positive. Okay. Those are good odds for me. I'm happy with that. So I need to take out that loan because I'm paying off a credit card. I owe $1,000 on my credit card. So I take my carrier loan and I tell my bank to go ahead and pay that debt. So the bank goes ahead, I pull the carrier loan from my private DFL bank, deposit it into my Wells Fargo checking account, tell Wells Fargo to pay my debt. They send the money to my creditor, and now that money's the creditor's money. It's now their money. My debt's paid, just like your current method. But where's my money? My money is still sitting in my bank, earning guaranteed interest plus a dividend. I'm getting positive arbitrage 17 out of 20 years. Whose money became their money? The carrier's money. Do I have to pay the carrier back? We already talked about that. Maybe. If I want to. Depends on where I am in the maximization versus accumulation versus distribution phase. And that's an advanced thing, and you're gonna talk with the broker underwriter that brought you here to make that determination. But in a lot of cases, it doesn't make sense to pay back the loan. In a lot of cases, it does. It just depends on what we're trying to do with the vehicle and where we are in that timeline. So how does the thing actually work? So let's show you an example. This is a family I worked with last October. And this is a standard family. They had both been married previously, so they both owned houses coming into the event. So they have 2 houses. The wife was a PhD student. She makes good money, but she's got a ton of student debt. The husband owns a trucking company and had just bought a big rig. They got nice cars. They've got a lot of debt. Because she's a student not making any income, just started to, and he's a trucker, 1099. They had some taxes, so that's where their debts are coming from. And because those student loans are in there, student loans are evil, people. Because those student loans are in there, they were going to be paying back that debt on their current schedule for 40 years. So they owed $585,000. This is not abnormal, folks. Realistically, what I see is somewhere between 300 and 585, man, 300 to $700,000 is the actual debt. If they have the ability to write a check and pay all that debt off at once, that's what I see. But when you look at the interest they're going to pay over time, 767 is what they were going to pay over the next 40 years. That's crazy. So we ran the numbers for them. We found out where they were overspending. She was, for example, she works in the state of Virginia as a college professor now, and she has the Virginia retirement system, VRS, which is horrible, by the way, for all state employees. And the VRS system they're matching her, I think, 3%, and she's putting in 10 because she's older than he is, and she wants to catch up. So that 7% overfunding of her 401k is one of the places where we found money, because I showed her that putting money into that without paying the taxes on it now is not a good plan. You're not going to have the ability to get that money back quickly. It's going to cost you more money, and if the market doesn't go up, you're not really making anything. Always take the free money, but you don't need to overfund. So this is what we did for them. Just using that 401k money and some of the other things that she was overpaying, 7.8 years. So we saved this particular family 32.2 years. Now, what's the difference? So in 32.2 years early, they're debt free versus in 40 years, they're debt free. So what does that really mean? That means we have created a scenario where not only are we saving $70,000 in interest, but we've created an additional 32 years that they can plan and save for retirement. Where before, on their current track, they were going to have 0 at retirement, other than whatever she put into VRS. So here's the truth. The numbers don't lie, people. It's just math. It is not magic. So we saved this family $70,000. We got him out of debt 32.2 years early. And in that process, that 40-year run, he's 36 years old. In that process, when he's 76, there'll be $4.8 million liquid cash sitting in their program. Did I create a bill for them? No. Are they spending any more money than they're spending right now? No. What am I doing? All we're doing is spending the money in a more efficient manner, getting that money exposed to compound interest to work for us, giving us the positive arbitrage instead of the bank. In addition, see that other number, 5.9 million? It also comes with a $1.1 million paid up life insurance policy that they don't have to pay for anymore because it's fully funded. So what did this family do? We went and basically created $5.9 million of generational wealth from this family using their current income stream with their current debt schedule without creating any additional bills. This assumes that they are never going to make any more money than they're making right now in their lives. It's incredible. So here's how it actually worked out for them. Every one of those yellow bars is a year in which we paid off one or more debts. Okay. So reading from left to right, that middle column, the loan payoffs, in the first year with them funding the program the way that they were, we paid off $14,915 in debts. Okay. But I want you to look at that last column. Even though we paid off $14,900 in debt, we also had $12,000 cash sitting in the program at the end of the year. So we paid off $14,000 and still had $12,000 left over at the end of the year. And the second year we paid off $15,000 more. And the second year we still had $40,000 sitting in the program. That number in that annual liquidity column, that's going to go up and down. It's going to yo-yo year after year, depending on which debts we pay off. Okay. And then in year 8, which is actually 7.8, we're paying off the last part of their home. We're paying off $117,000 plus $18,000 from savings. And then our loan balance is $177,000, but we are debt free other than the loan to the carrier. And then look at that very next year. See that loan, the EOY loan balance from CV, EOY stands for end of year in that middle section. In year 8, we were at 177,755. In year 9, we were at 117,472. How did that happen? That happened because the debt snowball is still running. We're using some of this to pay off the debt, and we're using some of this, the dividend, to pay off the debt. But no matter how you look at it, we paid off $60,000 of that loan in the first year. And look all the way on the annual liquidity column. Not only did we pay off $60,000 of that loan, we also increased the cash in the program by over $100,000, or just under 100,000, 99,980 something. Okay. So two things. So basically the value of the program between year 8 and year 9 increased $160,000. And that's not because they put in $160,000. That's the effect of compound interest plus a dividend plus the snowball. The next year, year 10, they're down to $54,000 on their loan, and their cash value is now up to $272. In year 11, they're completely debt free, no loans, no anything, and we're up to $375. The program is gaining $100,000+ a year cash value every year until they stop paying into it, which they can stop anytime they want. These programs are flexible premiums, folks. You got 3 price points. You can pay the minimum, which is usually about 1/3 of your target premium. You can pay the target, or you can pay some number above that, depending on how your broker underwriter structures this for you. So that where we structure that depends on what kind of debt load you have, because we're looking to incorporate that debt load. And look at this. In year 11, they're putting in so much cash into the program that the program is maxed out. They can't hold any more money in the program that year. So we have to put $11,000, this savings balance column, we have to put $11,000 somewhere else. Where do you put it, Jason Mitchell? You put it in another program that you start on another family member. You start a second bank, or you start a second bank on the same family member. It doesn't matter. But why in the world would you put money in a savings account and earn maybe 2% when you can put it into here and earn at least 4%? It's a no-brainer. You start a second program. All right. So I had him retiring at age 76, $5 million liquid cash in the program, completely debt-free for, at that point, over 30 years. He's actually incorporating this into his business, and he's using this to buy new rigs for his trucking company. So he's buying a brand new $80,000 rig every year, where before it took him 4 years to build up enough cash to buy a new rig. And this one, he's buying a new rig every year. So we have a debt-free life program running for him for his business as well. That program is actually generating about $40 million of retirement income in about 25 years. Okay. So, all right. So that's a family. They got real property. They've got houses. What about if you got somebody who doesn't have a house? So this is a student that I worked with the same day, same year. last year. She's 23 years old. She's a master's student. She's got a lot of debt. How much debt? She's got $85,000 of true debt, total debt. But then when you look at a lot of that is student loans. So did I say it earlier? Student loans are evil? Yep, they're still evil. They're even more evil now, right? So now she's got another $90,000 of interest over 40 years because it's a student loan. Okay. So what do? She's a waitress, folks. She's in college, works as a waitress. Can she afford a large premium? No. What's her premium? $350. What is that to her? Well, she works in a very nice restaurant. She makes a lot of money. That's about one night's tips for her. Okay. So she works 2 days a week. So this is one night a month of her job paying for this program. So one night a month. And this assumes, again, I'm going to say this. She's a 23-year-old master's student. Do any of us think she's never going to make more money than she's making right now? Do any of us think that she's not going to be able to overfund the heck out of this program when she decides that she wants to? So that 9.7 years, is that a real number? No, but that's what I can illustrate. The reality is when she graduates with her master's and then goes on to get her doctorate, she'll probably be able to pay off the balance of that probably in year 6. Okay. Anyway, what would we do for her? 9.7 years, saved her $64,000 in interest, created $603,000 in wealth. Okay. So if she stayed on the current track she's on right now, in 40 years, she would have zero in her retirement and she would have zero debt. That's great, right? I'd rather have zero in debt and 600,000 in retirement. Call me silly. All right. And not only that, remember that generational wealth thing? She's also got a $400,000 life insurance policy that's fully paid up. Never has to make a payment for again the rest of her life. So she has, at 23 years old, she's not married, she's not involved, she doesn't have children, but her family is going to be set whenever she decides to have that family. Here's how her program works. Again, a yellow line is wherever is 1 year that we paid off at least one debt. She said she wanted to retire at 65. I got her retired at 55. So at 55 years old, she doesn't have to pay another dime in the program ever again. The life insurance policy is fully paid up. It's $685,000 at that point. And more importantly, she's growing $22,000 a year without spending a single penny. That's like the creation at current tax rates today. That's the creation of a $35,000 a year income for the rest of her life. Okay. So that's really the end of the presentation from the beginning. So if you were invited here to take a look at Debt-Free Life, this is what it's all about. It's not magic. It's the creation of a vehicle that you get to own and you get to control, where you can grow money outside of IRS intrusion. One of the things I didn't mention yet is it's tort proof, which means if you get sued because someone comes on your property and breaks their leg and they take your house and all that other stuff, if you don't have an umbrella policy, but they know that you've got a 401k or anything like that, they can come after your 401k. They can attach that. This cannot be attached. It is tort proof because this is a contract between you and a carrier. So even a federal judge, a U.S. district judge, none of those people can order you to take money out of this program to pay a debt. Okay. It is completely insulated from the courts. It's completely insulated from the IRS. It's completely insulated from anybody who wants to sue you for any reason. Like they don't like the fact that you're wearing an Alabama hat, whatever. You can sue anybody for any reason these days. It doesn't matter. You won't win, but you can do it. And in the process, you're going to have to defend yourself. But in this case, they can't attach a lien to it. They can't ever go after it. So hopefully you guys got something out of that. Hopefully you got a few at least holy cow moments out of that, because every time I do, I see some of the comments that people leave, and they usually get something out of this. Let me show you. If somebody would unmute, I've got 3 different advanced products, advanced components that I usually go over. One's called mortgage chunking, which is a way that you can incorporate this program to rapidly pay off a mortgage. One's called daisy chain annuity stacking, which is a way that you can link monies from this program in the in that middle to end phase where you're going to increase the growth of your retirement. And one's a way to use your current mortgage to help fund this program. So I have time to do one of these. Does anybody have anyone in particular they'd like to hear about? Jason Mitchell, you're unmuted. What do you want?
Yeah, I am muted. Yeah, no, actually, fantastic presentation, brother. I appreciate it. I'm waiting for everybody else. I got I have a couple of questions.
Well, we'll get to the questions later. Hold that thought. Jose, you're unmuted. What would you like to hear?
Yeah, mortgage chunking.
All right, here we go. You had your chance, Jason. Waited too long, sir.
My bad.
It's all good. All right, mortgage chunking. Okay. All right, so mortgage chunking. So mortgage chunking that we're going to talk about today, it's not just for mortgages, really. There's a lot of ways you can use these programs, and chunking is really just the basic term. Any debt that's got a recurring interest rate, a revolving interest rate, any debt that where it's, as long as it's not simple interest, you can use a chunking scenario to do it. So what I'm going to show you here is, can everybody see my illustration? Somebody nod. Pat Hurley. All right, thanks. Very good. All right, so this is the same group that I used earlier. This is that family with the two houses and the student and the trucker. So this is so I'm going to use their mortgage of $215,000 as an example. This is their primary residence, okay? So using that as their primary residence, one thing I want you to look at, when you run a lot of these, you're going to see some similarities that happen. Most of the time, we're going to see years 0.8, 0.17, 0.25, 3, 4, 5, 0, 6, 7, 9, 2, 1, 2, 5, about 2.83. So somewhere between year 2.2 and 2.8, the majority of the smaller debts get paid off, okay? What does that do? That creates a large snowball. So in this case, by year 2.8, we've created a snowball for this family of $2,700 a month. That's beyond what their target premium was, okay? So keep that in mind when I show about mortgage chunking. 2,700, 2.8 years, all right? So mortgage chunking. So we're making some assumptions when we do chunking. We're going to assume a $215,000 mortgage, which is the scenario I just showed you. We're going to assume that the basic debts are going to be paid off in about 2.3 years, which is what the case was in this case. And remember how I said that mortgage in that particular instance was like $2,700 a month was the debt snowball? That's the roll-up debt, right? We're going to assume something less than that. We're going to assume $10,000 a year. Okay, so what I'm showing you, this is a mortgage chunking scenario where you're only making one chunk per year to start. Okay, keep that in mind. In the scenario using the family I just used, the reality is that family is going to be doing a mortgage chunk about every 4 months, a $10,000 chunk to their mortgage. Okay, so here's this family. The average, for those of you that have a mortgage, one of the things I want you to, at some point, if you haven't already done it, this is the whole purpose of what I'm getting ready to tell you, is so that you can go get disgusted with your mortgage company. Okay, so that mortgage company is charging you interest, and they told you some interest rate. They probably told you may have a great rate right now, like 2.95. Fantastic. What's the interest rate really? It's not 2.95. The reality is they're able to advertise that because at some point in the 30-year run of a 30-year amortization schedule, the interest that you're paying is only 2.95%. That's actually going to only happen in months, the 29th year, probably the 7th or the 8th month. So in the very beginning, this is standard across the board. Your first interest rate is actually 74% interest. So now that you're disgusted with your mortgage company, which was the goal of that statement, let me show you how mortgage chunking can allow you to get back at your mortgage company. Okay, so here's some numbers to pay attention to. First off, you've got a balance, $215,000 roughly. And let's assume you started that mortgage in May of 2020, right? So what did I say? I said 2.3 years. In 2.3 years, that debt snowball is going to be big, right? And we're going to have enough money, $10,000 in our program, that we can do our first mortgage chunking payment. So let's advance to 10 years, 2.3 years in the future. So now we're in May of 2023 on the amortization schedule. We have, just through the course of making payments, mortgage payments, we've paid our principal down to $203,000. You with me? Okay. So just by making those 2.3 years of mortgage payments, we've paid down our principal from 215 to 203,000. Not bad. We paid off $12,000 of principal. Awesome. Now, overnight, we're going to send a single check in. We're going to go execute our mortgage bank, our debt-free life bank. We're going to take a $10,000 loan out of our bank. It's going to get deposited into our checking account. We're then going to send a single $10,000 check to our mortgage company and tell them to apply it to principal. You have to do that. If not, they're going to do all kinds of screwy stuff and say, oh, you're just paying us interest in advance. Thank you. Apply it to principal. Okay. So now when I make a $10,000 payment, I go from 203,000 to 193,000. But what else happened? Look at where I'm in the amortization schedule. Overnight, I've advanced to September of 2025. From where was I? I was in May of 2023. So I've jumped 27 months into the future, 27 mortgage payments in the future with a single $10,000 check. All I did was pay off $10,000 of principal. But what else did I do? I eliminated $24,000 of interest. And more importantly, that number, $372, that's how much every single mortgage payment from this point future I'm paying in principal. The previous number was $332. Okay. So the mortgage payment, the amount of my mortgage payment hasn't changed. But what I'm doing is I'm making every single mortgage payment more efficient. I paid $10,000 in principal. I advanced 27 months into the future. I saved 20 plus $1,000 in interest. And that's all great. Okay. But what's even better is now every single mortgage payment I make in the future, whether I ever do a mortgage chunk again or not, every single mortgage payment is now more efficient. So what does that mean? The number is actually 11.6%. So I made my mortgage payments 11.6% more efficient paying my principal simply by making that one $10,000 check. And in the family that we're using, the example that we use, this family, they're going to be able to do that 4 times a year. How many times can you do it? I don't know. Depends on how much debt you have.
Hey, Scott.
Yes, sir.
Did you find the flux capacitor at this point?
Do I find the flux capacitor?
Yeah.
That happened earlier. Yeah, you missed that one.
Oh, my bad. Sorry.
Yep. All right. So that is how you do a mortgage chunk. The idea is that you want to get that snowball rolling, get your debt paid off, get you to that middle part, almost to that part, maximization, almost to the end of the maximization phase. And then you're looking at your mortgage. Here's the problem. The software that we use, which is very expensive, the software that we use does not illustrate or have the capacity to illustrate a mortgage chunk. So when I have to do that for my clients, I have to run a spreadsheet, and it takes a long time to run that spreadsheet. It takes me about 6 hours to run one of those analyses. I've done enough of them where I don't actually have to do it anymore. I can just tell you, yep, it's going to be 11.6% faster. So whatever in this scenario that we used where it said they were going to be out of debt in 7.8 years, simply making one mortgage chunk payment per year is going to get them out of debt 11.6% faster, which means it's about 6.7 years. So that's just one thing that they can do to really, really tweak. I'm a min-max guy, so I like to look at what's the best way, the most efficient way that I can spend money that's going to give me the maximum amount of return. There's lots of stuff you can do that's going to give you a good return, but mortgage chunking is one of the best. If you, as long as you have the discipline to do it right, okay? And that's the trick. That means you're not spending money on silly stuff, all right? So that's mortgage chunking. All right, Jose, hit it. What do you got? Or Mrs. Jose?
Amy.
Hi, Amy.
Thanks so much. If you just send in 10,000 that one time, all at
Yep.
once, would it have benefited if you sent like, you know, 1,000 a month to the principal rather than waiting to send that 10?
What you just described is actually more efficient than sending a single $10,000 payment in. Okay, the more you can send it in, the better. But what I'm trying to do is I'm trying not to get people bogged down with trying to manage multiple loans. So, you know, I mean, how much more efficient will paying 1,000 a month over 10 months versus paying one in 10 months be? Maybe 3 or 4%. It's probably worth pursuing. I'm not going to do it because it's onerous, but certainly, you know, but for me, I'm at this point, I'm helping about 60 or 70 people manage these programs. So I don't have enough time to go do that. I do an analysis up front where I'm going to tell you, this is the strategies you should have. This is where your snowball is going to be. This is how much your first loan is going to be. You're going to take 4 loans on the first day. There's going to be this amount of money in total. And you're going to take 2 loans at 2,000 and 2 loans at 4,000 because they're going to get paid off in 2 months and then 2 months and then your snowball. And then that one's going to be paid off. So that's the math that I do. And I only do it one time because it takes me forever to do all that math. But if you know, when you have your bank, you can certainly do that. There's 3 carriers we use. One of them doesn't have an issue with having a lot of loans out. So if you're going to do that, the multiple loan route, you're going to want to be with mutual trust.
Okay. And if you said it had to be in writing to your bank to pay the principal, so
Your lender, not your bank, when you're paying your mortgage lender.
you mortgage.
Yeah. And that's not just me, that's anybody. You know, if you ever sending in extra money, you need to make sure that they know that the extra money is to be applied towards principal. Otherwise, they're going to do however they want. They may say, oh, you're just making part of your payment in the future early, or maybe you're just paying extra interest early. They're going to do whatever's more beneficial to them. That's why you have to tell them and make a record of it.
Right. So how do you know that they actually did it?
Well, you can always dispute it as long as you wrote it on that check. And you can pick up your mortgage statement and say, oh, the principal didn't come 10,000, but I don't have any payments due until June. Oh, they just made, and then you pick up the phone and say, hey, listen, morons, I told you what to do.
Okay, got it. All right, thank you. Thank you.
And by the way, the squeaky wheel gets the grease. So be a pain in the ass to these people and they'll do what you want them to do.
Mhm.
And you can tell them I said that.
I will.
Give them a middle finger while you're at it for me.
Thank you.
Thank you.
All right. Anybody else? I don't see any. There's no questions in chat. Where are we on time? Oh, we're about there. Tom,
Yes, sir.
you got anything before we get going?
No, you did. I mean, again, a great job, and I'm glad you carved out some time for the mortgage chunking. That's always a very interesting topic for people. I had to take a call in the middle of it.